1. Exchange-traded funds, ETFs. ETFs are investment funds that are traded on stock exchanges, similar to stocks. ETFs are like the Swiss Army knives of investing. They've got a tool for every job. Whether you're into stocks, bonds, or commodities, there's an ETF out there just waiting to be traded. It's like having a buffet of investments at your fingertips. Just try not to get too greedy. 2. Mutual funds. Mutual funds are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets managed by a professional fund manager. Mutual funds are like the investment version of a potluck dinner. Everyone chips in a little something, and you end up with a smorgasbord of stocks, bonds, and other goodies. 3. Return on investment, ROI. ROI is a measure used to evaluate the profitability of an investment relative to its cost. ROI is like the scorecard of investing. The higher, the better. It's the ultimate bragging rights for investors, like hitting a hole-in-one on the stock market green. 4. Dollar cost averaging, DCA. DCA is an investment strategy where an investor regularly invests a fixed amount of money into a particular asset, regardless of its price. DCA is like the tortoise of investing. Slow and steady wins the race. It's the strategy of putting a little money into your investments on a regular basis, regardless of market ups and downs. It's like making small, consistent deposits into your investment piggy bank. Just don't break it open too soon. 5. Asset allocation. Asset allocation is the process of dividing an investment portfolio among different asset classes, such as stocks, bonds, and cash. Asset allocation is like playing a game of investment Jenga. You've got to carefully stack your assets to achieve the perfect balance. 6. Stocks. Stocks, also known as equities, represent ownership shares in a publicly traded company. Stocks are like the wild stallions of the investment world. They'll take you on a wild ride if you're not careful. 7. Bonds. Bonds are debt securities issued by governments, corporations, or municipalities to raise capital. Bonds are like the grandma of investments, reliable, dependable, and a little bit boring. It's like lending money to your friend who always pays you back. 8. Dividends. Dividends are payments made by a corporation to its shareholders out of its earnings or profits. Dividends are like the cherry on top of your investment sundae, sweet, satisfying, and oh so delicious. It's like getting paid to be a shareholder. Who knew investing could taste so good? 9. Capital gains. Capital gains are profits realized from the sale of investments, such as stocks, bonds, or real estate, at a higher price than their purchase price. Capital gains are like finding buried treasure in your investment portfolio. It's the reward for your patience and perseverance. It's like striking gold in the stock market mines. Just watch out for those pesky prospectors. 10. Risk tolerance. Risk tolerance refers to an investor's willingness and ability to withstand fluctuations in the value of their investments. Risk tolerance is like choosing your adventure in the investment jungle. Are you a daredevil or a scaredy cat? 11. Volatility. Volatility measures the degree of variation in the price of an asset over time. Volatility is like the roller coaster of emotions in the investment theme park. 1 minute, you're screaming with excitement, and the next, you're holding on for dear life. 12. Diversification. Diversification is a risk management strategy that involves spreading investments across different asset classes, industries, and geographic regions. Diversification is like playing the investment version of whack-a-mole. You've got to spread your bets to avoid getting whacked. It's like building a portfolio of investment Legos. The more pieces you have, the sturdier your castle. 13. Liquidity. Liquidity refers to the ease with which an asset can be bought or sold in the market without significantly affecting its price. Liquidity is like having a magical genie in your investment lamp. With a quick rub, you can turn your assets into cash. 14. Risk-adjusted return. Risk-adjusted return measures the return on an investment relative to its level of risk. Risk-adjusted return is like playing the investment version of Twister. You've got to twist and turn your portfolio to find the perfect balance of risk and reward. It's like walking a tightrope between greed and fear. Just try not to fall off. 15. Expense ratio. Expense ratio is a measure of the annual operating expenses of an investment fund relative to its total assets under management. Expense ratio is like the hidden fee monster lurking in your investment closet. The lower you keep it, the more money you'll have left in your piggy bank. 16. Index fund. An index fund is a type of mutual fund or ETF that aims to replicate the performance of a specific market index, such as the S&P 500. Index funds are like the lazy river of investing. Sit back, relax, and let the market do the work for you. It's like riding the investment gravy train, all aboard for smooth sailing ahead. 17. Asset under management, AUM. Asset under management refers to the total market value of assets managed by a financial institution, such as a mutual fund company, investment advisory firm, or hedge fund. Asset under management is like the investment version of Pokemon. Gotta catch 'em all. It's like herding cats in the investment jungle. The more assets you have, the bigger your safari.